This weighed on earnings and more than offset the impact from higher production volumes. However, Equinor has been disciplined and has been clear on their distribution guidance, and so we had called for a repeat of their buyback tranche of about 1.3 billion in 4Q. This will bring their overall distribution guidance, it'll achieve their overall 25 distribution guidance of 9 billion. 5 billion of that will be from buybacks throughout this year, and the remaining 4 billion is from their dividend policy.
Just hearing you say that made me recall an interesting tidbit from Enphase. So the 3Q readout was pretty good, but it was almost all on U.S. strength. So you've had a lot of safe harboring. You got this demand pull forward because of the expiring tax credits. So consumers are sort of racing to get projects started so that they can claim those credits. And we actually saw, I think, the sequentially European demand for Enphase or sales declined 38%. So we're seeing some continued weakness, at least out of the European residential market.
Iberdrola, it's the largest integrated utility in Europe. It is the largest by market cap across the stock 600. So for Iberdrola, it was another strong quarter of earnings. I would note that supply and generation businesses in Spain were a bit weaker than expected due to the ramp up of more gas-fired generation to stabilize the oscillations in the grid. So that's becoming a burden and a theme across Spanish utilities. Their power margins are being impacted, albeit modestly. And on the networks front, Iberdrola had a very, very strong showing.
My guys start reporting next month, and I think the earnings story for renewable developers is now broadly understood by the market. Power prices have eased in Europe, but they're kind of normalizing and they're steadying, especially from 2026. I think the key for Q3 to watch out for is really what are the capital spending plans for the midterm. These companies made really strong progress on their deleveraging programs in Q3. Most of them have already de-risked 80 to 90% of their targets for the year. And that was a really important step to clean out their balance sheets that have been very elevated for a while.
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Patricio Alvarez and João Martins joining from our office in Madrid. And hopefully we're going to have Will Hares joining us as well, though he's double booked. And so it might just be the three of us. Anyway, we've got enough of a group here to go ahead and kick things off. And we're going to start with 3Q earnings. We've got a number of companies in our franchise that have reported over the last week or so. So, Patricio, let's come to you first. Why don't we kick off with Iberdrola and then move through a few other names? But tell us what we heard and give us your outlook for the remainder of the year and what's ahead for 2026.
Sure. So Iberdrola, it's the largest integrated utility in Europe. It is the largest by market cap across the stock 600. So for Iberdrola, it was another strong quarter of earnings. I would note that supply and generation businesses in Spain were a bit weaker than expected due to the ramp up of more gas-fired generation to stabilize the oscillations in the grid. So that's becoming a burden and a theme across Spanish utilities. Their power margins are being impacted, albeit modestly. And on the networks front, Iberdrola had a very, very strong showing, actually. The company received some cost recoveries from the US, and they've also started recording UK capital allowances. And the fact is that the company is increasing capex in grids by more than 20% this year. They've also acquired a utility in the UK, so really the regulated asset base is going to expand by more than 12%. The company increased full year guidance for double-digit EPS growth, so they're actually going to grow almost 18% in 2025. And although that will set a high bar for 2026 growth, we think that the company will be able to continue to outstrip consensus and deliver mid-digit annual EPS growth in 2026. That's driven mainly by more organic investment. So the company is really plowing ahead with a 58 billion capex plan to 2030, mainly in grids. So we do feel confident about the outlook for that mid single digit EPS range. And I would note that something interesting across the European utility complex is that we are seeing signals of a recovery in the sentiment for renewables. And that's because Iberdrola put down a slide where they actually said, okay, we have on top of the 5 gigawatts that we're building, we have another 8 gigawatts that we have optionality to build. And what was interesting to hear was that was in case power demand grew faster than the current plan. So that gives us a little bit of a hint that the whole data center story is actually playing out here in Europe as well.
Fantastic. I do want to. We'll circle back around on the angle on renewables, but just a quick follow-up question. I saw hearing you discuss that reminded me of a cool chart I saw the other day. That was it was more U.S. focused, but it was trying to break down the composition of why in consumer electricity prices are increasing. And the analysis that I saw was basically saying that you actually have seen a slight pullback in the generation cost, but the big bulk of the component was distribution in grids. And I heard you talked about Iberdrola investing in grids. So is that sort of construct similar in Europe? You know, what's driving sort of cost inflation to consumers?
Yeah, sure. I think that's a great point to try and dissect the difference between basically break down the retail tariff. And I think you're absolutely right. I think that your comment is more US centric about the tolls that you pay for distribution and transmission on top of the wholesale cost of the energy that you're actually paying. You end up paying almost 2/3 of that bill are not your wholesale energy costs, are sort of your prepayments on investments that are going to, deliver returns in maybe 5 to 10 years. Here in Europe, I think Spain is a good example where more than 45% of the electricity mix is from renewables. So wholesale electricity prices are amongst the lowest in Europe. We're talking about almost 50% lower than in Germany on average. But since Spain has arguably underinvested in grids, and that was highlighted by the blackout in April. Right now, what we're seeing is the regulator telling utilities to ramp up gas-fired generation, and what that does is sort of stabilize the frequency on the grid or the voltage, but that actually leads to higher costs for consumers. So it's like no matter how you cut it, if you underinvest in the grid, you won't be able to absorb or to regulate that inflection in renewables. So arguably we have a renewable glut in Spanish grids, and we need those upgrades either via flexibility of demand, via gas-fired generation, or by investing more in flexible response and in grids basically, or batteries. So those are the three things that come into mind, and I hope that's helpful.
Yeah, very cool. Okay, let's switch gears a little bit. Will Harris, I see that you have managed to join, and I will just note that whenever companies report their earnings, if it's a notable company, if there's some changes in guidance or something surprising, we put out a react quite often. And so, Will, you've got a react out from earlier this morning on Equinor. It's called Equinor 3Q misses on price pressure, 4Q volumes to ramp. React. I'll drop the link for that here in the chat in just a second, but we'll break down Equinor's 3Q for us.
Yeah, thanks, Rob. So somewhat a disappointing 3Q for Equinor this morning. They did have, on the plus side, a very strong operational performance from their core Norwegian unit. This was driven by some of their core new flagship fields, Johan Castberg, which ramped up throughout the quarter. So we actually hit the highest production volumes that the company has had for a year and a half. So very strong operational performance on the plus side. However, all these extra volumes encountered a much softer commodity backdrop in 3Q, particularly on the US gas side, which saw realizations drop quite sharply. This weighed on earnings and more than offset the impact from higher production volumes. However, Equinor has been disciplined and has been clear on their distribution guidance. And so we had called for a repeat of their buyback tranche of about 1.3 billion in 4Q. This will bring their overall distribution guidance, it'll achieve their overall 25 distribution guidance of 9 billion. 5 billion of that will be from buybacks throughout this year, and the remaining 4 billion is from their dividend policy. We expect that this level, at least this level, will for distributions should sustain through next year. While the overall earnings were somewhat disappointing and was a miss versus consensus estimates, there is reason for optimism. So early in 4Q in October, Equinor brought on a very large Brazilian oil field called Bacalhau. This is their largest international offshore field in their portfolio, and it's going to drive significant production additions through 4Q and into early next year. So we expect to see a further production climb upstream, liquids weighted, which should help counter some of the soft pricing that we're also seeing in 4Q. So much so that we think the company will probably hit a 5-year high in upstream production volumes in the fourth quarter. So while it was overall a directionally negative as far as financial results, I think there's reason here to be optimistic on the operational front. They've been delivering and executing on their projects pretty well.
Okay, thanks, Will. Just a couple of items from my franchise. For anyone who didn't see it, Enphase reported after market yesterday. They are an inverter manufacturer, and they also sell batteries. And they actually had a really solid 3Q, beat consensus expectations for EPS margin on down the line. Although if you're looking at the ticker this morning, you're seeing quite a big pullback. I think the explanation there is that they've guided for a pretty weak 4Q with a difficult start to 2026 as well. Though I think we make the case that probably second half of 2026 looks pretty strong for a variety of factors. Also on the renewable front, we've had a couple other names report. Nextracker reported last week, had pretty solid outlook. Nordex, which hasn't given their full 3Q yet, did revise guidance for the full year and boosted their EBITDA margin guidance. So pretty strong readout from them as well. So while we're on the renewable bit here, João, let's come over to you. Maybe give us a quick preview on some of the European renewable developers and tell us what you're expecting for 3Q.
Yeah, sure. So my guys start reporting next month, and I think the earnings story for renewable developers is now broadly understood by the market. Power prices have eased in Europe, but they're kind of normalizing and they're steadying, especially from 2026. I think the key for Q3 to watch out for is really what are the capital spending plans for the midterm. These companies made really strong progress on their deleveraging programs in Q3. Most of them have already de-risked 80 to 90% of their targets for the year. And that was a really important step to clean out their balance sheets that have been very elevated for a while. they're not fully clean now. There's still some elevated leverage, but they're in a much better position. And for example, EDPR will announce a new strategy update along with their results. And I think what we're expecting is that these companies are going to try to balance improved policy visibility in the US, which is still probably the best growth market that they have, where they can still capture tax credits through 2028 probably, while still having these balance sheets that are not fully clean, that are still a little bit leveraged, but they need to capture this growth now, linked to the AI story that we've covered in many other calls. And so we're really trying to understand how are they going to be able to balance these two contradictory trends.
Joel, just hearing you say that made me recall an interesting tidbit from Enphase. So the 3Q readout was pretty good, but it was almost all on U.S. strength. So you've had a lot of safe harboring. You got this demand pull forward because of the expiring tax credits. So consumers are sort of racing to get projects started so that they can claim those credits. And we actually saw, I think, the sequentially European demand for Enphase or sales decline 38%. So we're seeing some continued weakness, at least out of the European residential market. Are you seeing the same thing on the utility scale side, or just give us a sense sequentially on how things look in Europe right now?
Yeah, I mean, I think from the utility side, investments in renewables are relatively stable but muted. So I think the US has really been the growth market for these companies, and they've got a 2 to 3 year window to build new projects still with tax credits, and I think that's really where they're focused. If you look at the European side, I mean, a lot of these players obviously they have large domestic investments, and they're still investing in their domestic markets, but renewables don't really have a lot of support in Europe either. I mean, we saw this week results for the UK wind auction that were potentially slightly disappointing. There's been a few offshore wind auctions in recent years that have also not been supportive. So really, there's not a lot of further scope in Europe. And as Patricio mentioned, there's markets where renewables are much more advanced already in terms of the power mix penetration. And so it's perhaps a little bit less exciting than the US.
Thank you, João. Okay, let's switch gears again. So for anyone who doesn't know it, we have a concept called focus ideas. These are where we have a unique call on a company that is by definition out of consensus. And so we're always looking for something that maybe the street doesn't quite appreciate. And Will, you've got a focus idea on TechnipFMC that you just reiterated earlier this week. And so we'll share the link for the focus idea here in the chat in just a moment. But can you tell us about their potential margin upside as you see it?
Yeah, thanks, Rob. So we came out with this focus idea earlier in the summer. TechnipFMC, for those that aren't familiar, is one of the premium offshore energy service companies globally. So specifically, they design, manufacture, and install the subsea infrastructure systems, and this includes piping, flow lines, and umbilicals to platforms, to floating production, storage, and offloading vessels, and all that side of the business. So they are active in some of the biggest and mostly prospective offshore basins in the world. So they get a lot of their work done in offshore West Africa, Brazil, Gulf of Mexico, and North Sea, and some in Southeast Asia. So this company is about 16 or 17 billion in market cap. They've roughly doubled in the last year, and have really been the industry darling compared to its peers. And I attribute this for a few reasons. Their backlog has just been unbelievably strong. They've just repeatedly and successively delivered above 1x book-to-bill in every quarter. They continue raising guidance, so they've raised guidance every year for the last 5 years at least. And also within their backlog, they are rolling off some of these legacy lower margin contracts. And what this culminates in is a just slow grind higher for their Subsea margin, and Subsea is their overwhelmingly dominant business unit. It's 90% or more of their revenue, and we have seen just a very consistent rise within this margin and on revenue year over year. And our call from our focus idea was that this would not only extend but accelerate. The company has an extremely dominant market position in many of these basins, but particularly so in Guyana, with a very strong client relationship with Exxon, where Exxon has awarded them all 7 of their major subsea projects. So our view was that in the summer that not only was 2025 management guidance too conservative, but that the street was also discounting the scale of upside for their subsea margin business in 2026. The company announced 3Q results last week, and they upgraded guidance in surface, which is their smaller business unit. So that was consistent with our call. But most importantly, they provided a preliminary guidance for 2026 on their subsea unit, which showed a 5% rise in margin and an increase in their expected EBITDA margin to 20 to 22%. Now, I think it's worth mentioning that their subsea margin in 3Q was already at 22%. So this company and the management team have a bit of a track record of being very conservative with their guidance, and we think that's the case playing out here again for 2026. We think that not only will they reach this new preliminary guidance, but that in all likelihood they will probably, as they've done every year for the last 5 years, upgrade probably around mid-year or maybe even 3Q as we saw this year as well. So the business is just incredibly strong, very dominant premium market position with all the leading operators globally in some of the most active and highest investment basins. With all these capital investment from these companies being deployed into these sorts of projects. So it's these large scale, multi-billion barrel offshore projects that TechnipFMC specializes in. So we see this strength, this business strength, and this cycle, this energy investment cycle, particularly offshore, continuing to propel TechnipFMC, and that's absolutely going to happen through next year, and it's probably going to happen through the end of the decade. So this is one of the strongest companies I have covered, and I think the market would agree. The stock price has just been on fire recently, and I think it's deservedly so.
Yeah, very interesting, Will. Kind of hearing you say that, it makes me kind of think about this working theory that I have, where you often see like a US company tend to have a little bit more conservative guidance so that they can beat it almost. Whereas I feel like a lot of European companies often like just try to nail guidance to where they're actually going to be. And they sort of constantly revise it so that they're right in a very tight window. So I don't know if you sort of share that same sentiment, but I'd be curious. And then just one quick follow-up. I know your note is very sort of focused on their offshore oil and gas business, but I think they have some exposure to offshore wind. And so I'm curious if any difficulties or headwinds in the offshore wind business kind of feed into this name at all.
Yeah, so just on your first point, yes, I think that it is absolutely correct. That actually, I think one of my old bosses always told me that you always need to underpromise and over-deliver with results, and I think that is that is absolutely the case here. Um, as far as renewables, the exposure is very limited for Technip FMC. Of course, they do have the vessels required for some of these offshore wind installations, but overwhelmingly it's subsea and their surface business.
All right. Fair enough. Okay, let's move on to a couple other interesting notes and ideas that the team has put out over the last couple of weeks. And Patricio, I want to circle back around to you for anyone who's somehow missed it. Data centers are very interesting thematically for the energy space. Pretty much any commentary you read, at least here in the U.S., but I think increasingly so in Europe, is that one of the big constraints on getting all of the AI data centers up and running is enough energy, enough electrons. And Patricio, you put out a note looking at what the potential upside is for natural gas demand in Europe that could come from data centers. So can you tell us about your note?
Sure. Sure. So I think we can start by laying the context for our scenario for European power demand and data centers. So our analysis shows that European data center power demand could increase 2 to 3 times by 2030. So that's from a relatively small base. Currently, data centers make up roughly 2.5% of European power demand. So we think there's potential for that to go up to almost 10% by 2030 on a high growth or fast growth scenario. Now, I think it's important to also note that we were not very optimistic about gas demand in Europe, mainly because the economics are just not as attractive as they are in the US. That's because Henry Hub trades roughly at less than half of what European gas trades at. So European gas is roughly $10 to $11 per MBTU. Despite that, we are aware that renewables alone cannot seize all this demand upside. That's basically because they're intermittent, so the load factors that we assume for renewables are anywhere from 20 to 40%, meaning that the rest will be met either by installing battery storage at scale, which seems unlikely in the near term. So the other option is to ramp up gas-fired generation. So our note looks at different scenarios in which there's 2 scenarios basically. One where the supply mix in Europe remains stable, where gas continues to contribute roughly 20% of the power mix, and in that case, in a fast growth scenario, that could add roughly 6 billion cubic meters of demand per year. So that is roughly just 1% of European gas demand in 2024. And let's say in a very, very aggressive case, where at least 50% of incremental power demand is met with gas-fired power, then that could go up to 15 billion cubic meters a year, which is roughly 5% of European gas demand. And although those numbers don't sound very exciting over a span of 5 years, we also have to know that European gas demand has been in structural decline since 2005. And even more so since the war broke out in Ukraine. European gas demand has declined by almost 20% since 2021. So we think that the deployment of data centers will probably stimulate some of that gas-fired power consumption. And I think a good example of that is perhaps, and I'll use this parenthesis to answer one of the questions in the chat, is, for example, in Spain. If anything, since the blackout, because that showed the frailty of the grid and an excess of renewables in the grid at the moment, since that blackout, the regulator has pushed utilities to increase gas-fired generation in order to stabilize the voltage. So in a way, that is already proof that if we don't have the adequate grids or the grid infrastructure in place, we will need other dispatchable sources, such as gas-fired power. And in the absence of battery storage, I think gas will definitely have to play a role, although not as prominent as in the US.
Okay, very interesting, Patricio. Zhao, I want to get you to weigh in on the AI angle as well. And I'll just note, you've got a really interesting note that's looking at Octopus Energy in the UK. And it's got a platform called Kraken, which I love that name. It made me it makes me sort of snicker every time I see it written. But there's basically an AI angle that relates to Octopus. So tell us about your note and your thesis on them.
Yeah, sure. So Octopus Energy is a private company from the UK. It's part of a Bloomberg Intelligence initiative to do more work on private companies. They are the UK's largest power and gas retailer. They were founded in just 2016, and in under 10 years, they took a leading 25% market share in the UK. They're also expanding very fast in Europe, and that retail story, first of all, it's unparalleled in the utility sector, at least in Europe. We're talking about quadrupling their customer base in like 4 years to nearly 8 million customers in the UK, more than 10 million overall. And that's underpinned by a few key differentiators against their peers. Number one is they have a cost competitive strategy that keeps prices, retail prices, below the regulator's price cap. So they're competing on cost on the one hand. And then that's all enabled by a unique tech integration across their business, across their retail business and other activities. And that's to do with this platform that you mentioned, Kraken, which is an AI-powered platform that they use internally for their customers, but they also license it to other utilities. And it essentially allows a utility to manage customer relationship, to manage their assets, to manage the workforce and dispatching of engineers, and so on. While it also, if you're a client of one of a utility that is licensed to Kraken, you also have access to the platform, and you can also optimize your assets. So, for example, things like EV chargers, etc., all powered by AI, and that's an even faster growth unit for Octopus. It's currently being demerged from the group, but so far it's been a really important part of the growth. It's still going to be licensed to the retail unit, so we don't envision any big changes in terms of the operational efficiencies there. But Kraken itself has about 70 million accounts, and just to clarify, that means 70 million meter points currently. They're targeting 100 million by 2027, which we think is credible. And then they have an even more ambitious target of 1 billion accounts by 2035. And that's underpinned, obviously that's a lofty goal, but that's underpinned by a widening of their addressable market. They're not just focused on energy utilities anymore, they're targeting water utilities, broadband companies, and that might expand. And they're not just in the UK, they're in Europe, in the US, in Australia, really everywhere in the world. And so this puts them as a unique company in our sector. And then the last thing that I would maybe say on them, if you look at their profitability, their retail profitability now, and we're always discussing whether AI is a bubble or not, right? And whether there are real returns and real impacts from integrating AI. If you look at Octopus's retail unit, their profitability trails peers by 20 basis points right now. But that's because they're spending massively on marketing and talent acquisition. Their expenses on those nearly doubled in the last year. But their cost to serve is something like 40% cheaper than any other peer. And that to us suggests that their midterm profitability potential is much bigger. And that's all underpinned by technology and AI.
Okay, thank you, Zhao. A couple more items before we close it out. But just this week here, we've seen some really interesting news out of the U.S. on the nuclear front. And basically, to summarize, the U.S. government under the Trump administration has entered a partnership with Westinghouse, trying to kickstart the conventional nuclear industry, aiming to get construction of 10 new reactors, a deal of something like $80 billion. And so, I think there continues to be a lot of interest in nuclear on the AI data center story. And one of the things we've been arguing throughout all of this is nuclear is pretty interesting, good technology. It's certainly very good for carbon-free baseload electricity if that's what you're looking for, but the lead times are just really long. So if you're thinking about the data center demand surge, we just don't see nuclear playing a significant role over the next sort of 5, even 10 years, but maybe mid 2030s and beyond. It's sort of got quite promising here at the moment. But Patricio, let's get a readout from you on just kind of the nuclear story in Europe right now. Are we seeing any similar enthusiasm for the technology over there?
Yeah, I would say definitely we are seeing excitement, and nuclear is in the headlines here in Europe as well. But I would say that it's just not as exciting as the story it is in the U.S. And that's I would say that one of the key differences is that, well, one, Europe's policy is mandating the shuttering of several nuclear plants, including ones in the UK. And that contrasts with the current government's plans to increase capacity. But overall, Europe continues to be on track to have a falling capacity number by the end of this decade. That's despite a few planned additions, including Hinkley Point C, which is, yet remains to be seen if that plant will actually be built before 2030. You have, for example, Flamanville in France, which took more than 10 years to build, and at an average cost of 10 million euros per megawatt, so making it one of the most expensive plants ever built. So on that front, I think that in Europe there's not this I would say this very consolidated political and policy support for nuclear as there is in the U.S. The other key point is that perhaps the pace of investment in data centers is unparalleled in the U.S. And why do I say that? Because you've seen deals like the 3 Mile Island and Dwayne Arnold, which are plans basically where the hyperscalers have contracted with the utility for that power to restart idled power plants, nuclear plants, to feed their data centers directly. We have seen no evidence of that here in Europe, so which tells us that investment is happening, but perhaps not with the urgency that it does in the US. That said, there's still SMRs, so there's plans for small modular reactors, both in the European Union and in the UK. We think that Rolls-Royce's SMR model is probably the one first in line to get built. But like you said, that has to go through a lot of permitting and regulatory hurdles. That reactor, the 470 megawatt model, may get full regulatory approval by 2030. And then, perhaps we'll see a commercial pilot by the early 2030s. So that will be perhaps a great complement because we will still need that baseload supply. And if anything, it may help Europe's baseload supply over the long run. So if we're talking about 10 to 15 years, I think nuclear definitely will have a place. But perhaps in the front end of that demand increase for data centers, I think it's battery storage and probably even more so gas. That will have a place in balancing intermittent renewables.
All right, last topic for the two of you. You guys put out a note about a week ago looking at Latin American utilities, investment in grids and renewables. And so, João, let's come to you. Can you give us a sense of, what's sort of often overlooked part of the world. I suppose there's a lot more interest in the United States in Latin America these days, particularly a lot of interest in Argentina. But give us your readout. You know, what's going on down in that part of the world, and you know, how should investors be thinking about that region?
Yeah, sure. So we've looked at Latin American power markets in connection with our AI series, but also ahead of COP30, which will be hosted by Brazil next month. And maybe the key highlights there are one on the AI piece. We built a scenario for data center demand as we did for other regions, which the growth rates kind of align to what we see in Europe. So 2 to 4x growth to data center power demand in Latin America by 2032. But what's interesting is that that's only going to represent something like 2 to 3% of the entire load, which is much less than in Europe and for our forecast for Europe and the US. The reason being that this is a region that already has very strong underlying growth drivers, which include in electrification of homes and transport, sustained underlying economic growth, among other things. And so really, and the other factor is that the region, and particularly Brazil, which represents something like 40% of the entire power demand of the subcontinent, the region has oversupply of power and overcapacity of grid. So we're in a completely different environment than compared to Europe, where we're trying to find grid capacity, etc. The problem that the region has is a bit more intense climate risk compared to North America or Europe. It's seen recurring events of droughts, and the region relies a lot on hydropower for its generation. It's seen recurring droughts. It's seen very extreme floods and heat, extreme heat events. And that all disrupts the power grid, it disrupts generation assets, it generally leads to losses for utilities. And so what the sector is doing there is to pivot, like it's doing in other continents, in Europe and the US, but for different reasons, it's pivoting CapEx towards grid reliability. And if you look at historically, utilities in the region used to invest about the same in grids and generation assets. Going forward, we think they're going to invest twice as much in grids, which on the flip side is a positive because it will drive more steady earnings gains with stronger visibility, and the regulatory frameworks in South America are very positive. So there's an upside for the investment case in utilities there.
One quick follow-up, hearing you mention the COP meeting, the last one of those I went to was the Paris climate meeting about 10 years ago at this point. And that one seemed to have a lot of engagement from industry at the time. So a lot of oil companies, a lot of utilities, they were engaged in the conversation and participating. My general sense is that the sort of industry stakeholder engagement has really backed off on that. But tell me, are a lot of folks headed down to Brazil that are outside of the policy apparatus this year, or is it mostly just government officials in here in 2025?
I mean, I can only give you a sense from the companies we cover. I think it's not been widely mentioned. Actually, most of the companies that we cover that have global portfolios have kind of reduced investments in Latin America over the last 2 to 3 years. They've even sold some assets. I think in Brazil specifically, they're giving it a lot of importance, and perhaps more than in other years, because it does tie into a lot of topics for the economy there, right? Brazil has one of the cleanest power mixes, and so there are things that they can sell in connection to COP30, but that's just my sense.
All right, we'll leave it there. So I want to thank everyone for joining us here this week. We appreciate you giving us some of your time. I hope every bit of discussion has been useful. And just want to remind you that, we're not just faces on the screen. You are welcome to shoot us an email, shoot us an IB if you want to chat about any of the things we discussed, or if you just have general questions or ideas you want to chat with an expert in on the space, just shoot us an IB. We're happy to engage with you and address any questions, comments you might have. So thanks, everyone. We will see you next week. I think next week we are going to be back to a 5-hour spread between US and Europe. So this week was only 4 hours, but next week will be the usual time in US and Europe, 10 a.m. New York next Wednesday. Take care, everyone. We'll be in touch. Cheers.